Hi everyone, Gigi Santoro, Santoro & Sons Real Estate Group, and today we have a fantastic video where we are going to talk about market conditions with Edwin Davidian from Skyline Mortgage. Edwin comes to us with more than 16 years of experience in the mortgage industry, and previously he was in the financial sector as a CPA. So he's very well educated and can certainly talk about this topic. And I think I have 7 or 8 good questions for him today, so let me bring him in. Come on in, Edwin.
Hi, Gigi.
Good to see you.
Nice seeing you.
All right, let's get right to it. Okay, Edwin, market conditions. Okay, first question I have is, what are the market conditions that you see being a factor in rates today?
Well, I'm sure you've been following the financial
Yes, I have.
news. Unemployment rate is at a record low. Overall, the world economy is doing really well. And, the Federal Reserve is really trying to, reduce their balance sheet. That means they want to increase the interest rates.
Did you see the rate hike coming in December?
I think so.
Okay.
From what I see, what I read, I believe there will be a rate hike
Like
in
how
December.
much? What do you think?
Probably 1/4%.
Okay, how does that affect the rate today when it goes up 1/4%? Because what I notice with this industry is there will be the potential rate hike and you see it come in advance of the Fed's announcing.
Sure.
Sometimes then I see a reduction after the Fed's announce. It's almost like I'm going to hold my breath and then, it wasn't so bad.
Absolutely.
What is the reason for that?
When the Federal Reserve increases the federal funds rate by 1/4%, it's not really that has an effect on the short-term rates, not long-term. But the anticipation that you just brought up, that because the market is going up, because the economy is doing well, in anticipation of that, rates, long-term rates, which is mortgage rates, they start creeping up.
Right.
Okay. So, and what would trigger that? I think it's the U.S. economy, and because we are in a global economy, so whatever happens outside of the U.S. really affects us.
Right.
Okay.
Right.
So, but overall, it seems Europe is doing well, and global economy is doing well. So I think we're going to see more rates going, higher and higher from where we are right now.
Okay, so what types of programs do you forecast that will help to ease the rate hike? Like before we got into trouble, when there was craziness going on, there were all kinds of amazing programs that got people into properties with negative amortization. I bought a property, and I wasn't an agent back then, but I bought a property and I put $20,000 down for my earnest money deposit, and I picked up that $20,000 when I closed escrow. So that doesn't happen anymore.
Yeah.
But how does this?
And I really don't think, that's my personal opinion, I really don't think that we will see those crazy programs. 100% financing.
Right.
Or what we call stated income.
Right.
I don't think we'll see those programs per se.
They're existing now, though.
They do exist, but they're still a little bit more restrictive. For
Okay.
example, as a matter of fact, we do offer what we call alternative documentation, alt-doc programs.
Alternative documentation. Okay.
Okay, so it's alt-doc. So all we ask is for 2 months of bank statements. Yes, but minimum down payment is 25%. So when we were talking about what is the difference between now and then, back then you could have bought a house 100% financing with stated income.
Right.
But right now you have to have a good credit score, and you have to put minimum 25% down.
Okay.
So that's, so basically you're answering to your question, what we see to ease that. Well, back then we used to do a lot of ARM product, adjustable rate mortgage
But they're
product.
very popular right now again. I'm seeing my clients are taking an ARM product because the rate is so low, but there's a cap on the ARM that's not so bad now.
Well, it's been the same. So the cap on the ARM, it's 5%.
Okay.
It's the lifetime cap, okay, and it's 2% annum. Okay, so that, for example, if somebody is taking a 7/1 ARM, 7-year fixed, and 23-year adjustable, for the first 7 years, the rate is fixed; it doesn't change, and after that, the maximum amount that he could increase is 2% a year. And it's always been like that. Well, let's just say, let's just say that they take a loan today with 3.5%.
Okay.
Okay, they start at 3.5%.
For the first 7 years.
Yes.
Okay.
So the maximum this 3.5 could go up in the next 30 years, in essence, right? Is 3.5 plus 5. It could be 8.5. Okay, that's the maximum, right? But
because the 5 you're saying is
It's-
the okay, but at 2%, I got it.
2% a year.
Did you get? Let's explain that again.
Okay, so if you have a 5% cap
Right.
on the entire time of the loan, which is a 30-year loan, but it's fixed for the first 7 years.
Right.
Okay, so after the 7th year, right, if it's going to get adjusted, it would not increase more than 5%.
Over the entire
Over the entire 23 years.
years. Okay.
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 But it cannot increase by more than 2% a year.
Okay.
Okay. So it's popular, yeah, but it could be popular because it depends. Everybody's scenario is different, Gigi. You know, so if you have a first-time home buyer, professional, an attorney, a successful CPA, or a physician, that they know that they will be moving out of this house in the next 5 years. So why pay? I don't want to say higher rate. Yes, I mean 30-year mortgage today, it's like somewhere around 4%. But if you can get a 7-year 7/1 ARM at 3.5 or 3.375, why pay the higher rate? However, it's good for those.
Because if you're gonna, but it's if you're gonna leave the
Yeah,
house.
if you are.
Okay.
If not, being conservative, I think. I mean,
If you're gonna
again.
stay there 30 years. You should
Yeah,
get a
and
fixed
I
rate
really
loan.
think that probably 75% of the market still are doing 30-year fixed.
Right.
You know,
Okay.
because the rates are so low right now.
Okay, in a typical situation with a rate hike, what generally happens to home pricing in your opinion? So my concern about the market is we have a bunch of houses for sale for $1 million at, what did you say rates were?
3.875.
Yeah, 3.75, whatever. And now we're going to see an increase in December, which is going to translate to higher rates. And so what do you think is going to happen to the buyer's power at that moment?
Yeah, to be honest with you, I mean, a lot of people ask me this question. Again, that's my opinion. If the rates go up from, let's say, I mean, just make it simple. Let's say it's 4% today, which is not, it's lower than that, but let's say it's 4%.
Okay.
And I have no idea what the rates could be in the next year. But let's just say 4% to 4.5%. I mean,
Okay.
it's still a great rate. I mean,
Right.
we used to do loans at 6.5%.
I know.
So still 4.5%, right?
Right.
The 0.5%. So let me just do a quick calculation for you. For example,
Okay.
if we buy a house for $1 million today, and we put 20% down, because usually people put 20% down, and at a rate of 4%, including property tax, insurance, and so on and so forth, basically PITI. Okay, you're looking at payments of $4,965, right? Let's just say the same $1 million, rates
Right.
went up to 4.5%.
Okay.
Okay, the payments will jump to $5,200.
What's the difference between the
So
49.65 and the 52?
49.65. So 49.65 minus 5,200, it's $235. So do you really think someone who's buying $1 million house is going to worry about $235 going up? I don't know.
It depends if you're stretching, and I think that's what a lot of people
Exactly.
are doing right now
Yeah,
because
so-
the market is. The
So if
market.
you, I mean, again, so if again, it's very relative.
Mm-hmm.
So somebody who's buying $1 million house, that individual should have a good income anyway. It has to have
Yeah.
a 6-figure income.
To be able to
So
afford it.
235. I mean, yes,
It
it's
seems like a lot of money, but when you really put it into perspective,
Yes.
if you have a housekeeper or a gardener or whatever, your gardener is probably about $100 a month. So you start to figure out that 235 doesn't really, it's not
play a
as
big
bad.
role.
It's
So
not as
so
bad.
depends if the rates go increase more than 0.5% to 1%.
Right.
Then that difference, I think, it will be substantial. That will be close to $500, and that may probably cause the
right.
price.
So if it goes from 4 to 5,
then you're looking at $500 difference.
and are you seeing
I really don't.
5% rates for
Next year, 2018,
2018?
I don't see it.
You don't see it?
No, not from 4 to 5. I don't see it.
Okay.
Okay, I mean, I could see maybe 0.5%,
Right.
maybe 5/8, but 1% is a huge number. Again, that's my opinion based on
Right.
my information, my knowledge.
Right.
You can,
Okay.
You know,
So if the feds raise the rate 0.25% in December,
yeah.
then how will I see that increase?
You're not going to see it quarter to quarter. Like if the federal funds rate increases by 0.25%,
Uh-huh.
okay, you're not going to see that the mortgage rates went up 0.25%.
It's not relative.
It's not relative, but because we talked about it, it's an anticipation because the whole economy is
Right.
doing well,
Right.
and therefore it's going up. And I think if you really follow the 10-year Treasury yield, that is a good, good model to follow to see what could happen to the rates.
Okay.
Okay, so the 10-year Treasury, I think today is at, I think it closed at 2.452. Okay. So just to give you some kind of a idea as to where we were, let's say 3 months ago. So 3 months ago, back in let's say back in August, we were around 219. Okay, and 6 months ago, back in let's say June, we were at 2.214. Okay, so you can see the gradual increases. So as the 10-year Treasury,
much bigger increase though from August to now.
that's right. So
than
so basically, what I'm trying to say, as you can see, as a 10-year Treasury increases,
Right.
the mortgage rate increases as well.
Okay. Is there a cyclical time in your year of mortgage increases?
No.
Like, I notice sometimes that I see a lower rate after the first of the year for some reason. Is that just because I've been more aware of rates at that time?
Yeah, maybe. Yeah, because I really don't think so, and I really don't want to come with this theory as to first of the year on Fridays or
Right.
on Mondays. It really depends on the economic data that comes out and
Right.
what's going on, so that affects the rate. So I don't subscribe
Well,
to that
because
kind of.
I'm
yeah.
looking here, and you say 6 months ago was 2.14, and now 3 months after that, or 3 months ago it was 2.19, and then today it's 2.452. So
Yeah.
that seems to be the end of the year because everybody's excited and the year was pretty good. Now I think maybe retail doesn't do so well for the holidays, something, and does that affect it starting in the first part of the year?
Again, it's hard to say because
Yeah.
what happened with the hurricanes, what's
Right.
going on with Puerto Rico.
People are saying with the hurricanes that they're expecting a 3-year bump in the economy because all these properties have to be rebuilt. They have
Yes,
to buy
auto-
furniture
and
they have-
automobiles.
automobiles too, right? It's
Yep,
a big thing. So
absolutely.
I think it's kind of scary that it's an inflated bump because we may not have seen that had we not had Mother Nature's
That's
assistance.
right. So just the information, the 10-year Treasury in the last 52 weeks, the lowest has been 1.77
Oh wow!
in the last 52 weeks,
Wow.
and the highest has been 2.6.
Wow.
So we were really down, and we went up, and we came back down again. So it really fluctuates. So again, I think it has to do with the economy, what happens, and hopefully.
I get so much information every time I talk to him. I took copious notes here to write down for later because it's so complicated. So thank you so much for tuning in once again. This was great information. Edwin does a fantastic job. If you ever need a lender, he's your guy. Look for his information down here. And if you ever need a real estate agent, I'm your girl. Have a great week.
Thank you.